This is our Forex blog for June 6, 2012, and I've created written rules for our easy three-step Forex trading system. Step 1, use our currency meter, which you're about to see, or a sorted hot list, and sort it strongest to weakest. Find the strongest currencies to buy and the weakest currencies to sell. You want to focus on buying the strongest ones, selling the weakest ones, and ignoring the rest that aren't moving, basically. Step 2, wait. Too many traders are impatient. You need to have patience and discipline. Sometimes you sit down, maybe 20% of the time, and you'll find a trade in 5 or 10 minutes. Other times you might have to wait 30 minutes. Just be patient. Buy the strongest currencies when you see a buy signal on the chart, and price goes 1 or 2 pips above the previous bar's high. Or for those who are more, nervous, anxious, or you could even say conservative traders, wait for the trailing stop to get hit and flip down below the price and turn green, then buy. Basically, this is a form of insurance. You'll have fewer losing trades, but you also tend to get a worse price. You might buy 3 to 8 pips higher. That should, and oftentimes does, get rid of some of your losses. But on big wins or even small wins, you might have a tiny loss versus a 5 or 6 pip win if you get in based on our regular rules. For sells, sell the weakest currency when the sell signal shows up and price goes 1 pip below the previous bar's low. Or you can wait, again, for the trailing stop to get hit and flip up above price and turn red, then sell. Again, this is a form of insurance. Most times you have fewer losses, fewer trades. However, you have to pay for insurance. And then for exits, inexperienced traders or traders with small accounts, under 50,000 is a good rule, maybe 25,000, should use trailing stops for your entire position. You might have 2 or 3 or 4 trades on at the same time, and because you have a smaller account, you have used all your leverage. Professional traders and those with larger accounts should exit half of their trade, and this is how I trade, using these rules. If price stalls at the next support for sell trades or resistance for buy trades, exit half your position. And I list here the support resistance areas I use, and also in the order of most significance. Fibonacci profit targets or retracement levels, previous month's high and low, then monthly pivots, previous week's high or low, then weekly pivots, previous days high and low, and then daily pivots. So in other words, if the market's going up really strong and you see a previous day's high or low or daily pivots, it's more likely you're going to go through it, especially if it's only gone up 15, 20 pips. If it's up 40 or 50 pips, then even the previous day's high and low, and especially the daily pivots, which have the least significance that I feel, that I use, they're going to act as support resistance. The bigger the move, even the weaker areas are going to hold. If the price, if you buy it and right above you is a major resistance area like Fibonacci profit target or previous month's high or low, more than likely it's going to stall there. It might go sideways before exploding through it, or it might hit it and fall like a rock, or it might hit it and kind of gradually come down. You never know. That's why I tend to exit half of the trades at these areas. And then you want to exit the remaining trade at or above the 1.618 fib target. Probably 75 to 80% of the time, the 1.618 fib target of the last wave up is going to be the maximum profit. It might go 3 to 15 pips above there, and you don't have to exit exactly at that level, but watch it like a hawk at that level. Any sign of it not going up, or a red bar for buys, green bar for sells, exit your trade. Or use a trailing stop. And the majority of the time I use a trailing stop unless the market explodes up, hits the 1.618, maybe it goes a few pips. Sometimes I see them go 20 pips above that. They almost never go above or below the 2.0 fib area. The bigger the swing that you draw the fibs on, the more likely they are to be useful. This is the first day I've put this on our Forex blog. I probably will spend less time going over it on days to come. You can also pause the video and or take a screenshot of this and memorize these rules. So here's the currency meter that I discussed, and the new one allows you to sort the currencies. These are the individual currencies. I want to sort this from strongest to weakest. Right now, the New Zealand, Australian, and Swiss are the 3 strongest. The New Zealand's going up against 100% of other pairs on the hourly chart, the Australian 85%, Swiss 71%, and the dollar is the second weakest, and the weakest is the yen. So the real-time trend strengths on the top, and I have the 15-minute trend, hourly, daily, weekly, monthly. The more time frames that are up, the better. So after this little bit of weakness right here, let's say at 9, the strength comes back in, you want to trade it against one of the weakest ones, the yen or the dollar. So let's bring up the New Zealand dollar chart, or actually the yen's the weakest now. We'll bring up the New Zealand yen chart. And basically this is what I mean by waiting for a signal. You can wait for a signal and then buy it when it goes a pip or two above the bar's high. I typically put my stop right underneath the bar. So in this case, you would have lost 8 pips, and then you would have had to get back in it again here, and you made it, about 10 or 12. And this is the reason why a lot of people are using the trailing stops for their entries. You get an entry right here, or a signal. Normally you buy 1 or 2 pips above the high. That's right here at 54. A lot of times the previous swing high is the area where it's going to stall at. That's only 10 pips up. It comes down a little bit more. You get into this trade right here, and it pretty much within a few bars starts going your way. If you got into this trade right here at 52, you exit this trade at 64, you made 12 pips, you have another entry right here. You're in this trade here at 68, you're out at 79. And of course there were a lot of trades earlier in the day. You see this buy signal right here. You waited for the trailing stop. Actually, the trailing stop got hit on this bar around 98, and it got you out up here at 37. Nice, almost 40 pip move. The circles are counter trend trades, and they're colored based on different colors, mainly for internal use only, so I can identify what type of signal showed up there. And if I start getting some bad signals, I can tweak the code. There's over 20 different patterns that I look for on the range charts. But nonetheless, the 3.0 green band usually is the maximum high. So even though it's super strong, when it gets to that green level, very likely to end. 20-day moving average, also key resistance area. So notice this buy right here. You would have either got into it right here at 31, or when the trailing stop got hit at 34. 3 pips is not a bad price to pay for insurance. You might decide, if the trailing stop's really close to where you're planning on getting in, you might wait for the trailing stop to get hit. If it's farther away and you believe in the trade, you don't want to pay up 8 pips to get into the trade. Buy it when it goes 1 or 2 pips above the bar's high. If you see a bunch of up, down bars like this, and then the buy signal, wait for it to go above, 1 pip above the highest bar's high, just to avoid unnecessary losses. But you can see this was a very strong currency today. If you focus on buys, you have this nice trade here, pretty much 2 pips here, nice win here. If you bought this one right here, you lost money. Obviously, if you waited for the trailing stop, you still lost about 5 or 6 pips. Got in right here, here, and here. Let's look at the New Zealand dollar. Again, focusing on buys. Up, up. This one here failed. Up, loser. This one probably broke even. Loser. And again, buy signals here and here. If you waited for the trailing stop to get hit, you avoided a loss. You would have made money in a second one regardless. And this trade, took off, and you got out here at 57. You're in this trade at 16. So the whole point of trading the strongest and weakest ones is to catch these big wins. Now, one other thing I said was use Fibonacci profit targets or the trailing stop. Trailing stops work for new traders or traders for smaller accounts. If you draw your fibs on this, if you were still on that trade or you decide to buy it again right here, usually the 1.618 is the maximum area it goes. Sometimes it goes a little bit above there, like you can see. If it's as strong as it is today, I might have held on. As soon as I got this red bar, I would have been out, and it would have been out pretty much the same as the 1.618. The next area that went up and then went down was right here at 95. So that's only 6 pips above where the 1.618 is. And most of the time, when it hits this area, it falls back pretty fast. Another one that was strong throughout the day, and even probably stronger earlier in the day, was the Australian. So again, looking for Australian dollar buys and Australian yen buys. Notice buys, up, up. And again, when it's above the white 2.0 band, it's pretty risky to buy. I usually don't buy these. I would wait. I would have taken this one. Actually, before 3 o'clock in the morning, I wouldn't have taken that one. I would have taken this one, not that one, this one. Probably would have taken this one and lost. The market, as you always want to watch your real-time tools. Strength, very little or a lot less weakness on the pullback. Strength, pretty decent weakness on the pullback. I might be a little bit more cautious in taking that trade. And you always want to draw fibs on the previous wave as well. Here's the low. Here's the high. A better trade is to waiting for a 38% pullback somewhere around this level here. Also keep in mind the new fib tool we have that we should release soon shows you the price that you're picking at the high and the low and how many pips the move is. It also will snap automatically to the high or low so you have perfect fib prices. If you don't want it to snap, you hold it in your shift key and let go. So you can see from here to the low there's 162 pips. Try not to draw fibs on swings less than 25 to 35 pips. You know, if it's a lower volatility currency, you might go down to 18 to 22 pips. Higher volatility currencies, 20 to 25 minimum. Again, once you select it, it automatically snaps to the high and low of the bar, which gives you more accurate fibs. And it also gives me more accurate fibs in drawing longer term Fibonacci areas. So let's take a look at the Australian yen, another strong one. Notice again how the 3.0 band, the green band, tends to be the high of the move. If you wait for pullbacks right here and here, it's a much better trade than buying way above the 3.0 level right here. Wait for a decent pullback. Also, if you get a pullback, draw your fibs on it. Usually somewhere between the first and second fib target. If you get a buy right here, it's a pretty safe trade. You might have got into this trade here, lost 8 pips, got in again, and then made 10, 20, 30, 40, 50 or so pips. The key is small losses, big wins, and that's it. There's nothing else you really need to do other than focus on buying the strongest currencies, selling the weakest.